You did everything right. You skipped the meme stocks. You ignored the crypto hype. You diligently put your money in a high-yield savings account, earning a respectable 4%. You feel responsible. You feel smart. But here's the punchline to the joke you didn't even know you were in. Your safe money is quietly, relentlessly losing the only race that actually matters. Because while you were patting yourself on the back for earning $40 in interest this month, your grocery bill just casually jumped by $80 compared to last year. Your rent went up $100. Your gas is costing you $50 more. Congratulations! You just invented the world's slowest, most responsible feeling money-losing machine. And while you were busy playing defense, trying not to lose, there's a fund out there that has been quietly playing offense. It's been paying out a dividend close to 8%, and it pays monthly. And not once in 39 years has it cut that dividend. Not 39 months, 39 years. And almost nobody is talking about it. Let's get real for a second. Let's talk about the cold, hard math of playing it safe. You have $10,000 in that high-yield savings account, earning 4%. Great, that's $400 a year. It feels like something. But right now, let's say inflation is running at 5%. Do the math. Your real return is negative 1%. You are not making money. You are losing purchasing power, slowly, quietly, invisibly. Every single day, your money buys a little bit less than it did the day before. The banks love this, by the way. They use your cash to make a fortune while you get the illusion of progress. Meanwhile, there's this fund, ticker symbol DNP, the DNP Select Income Fund. It's currently paying out a dividend yield close to 8%, and it pays monthly. Let's run those numbers again, but with a bit more at stake. Say you have $100,000. In your safe savings account, that's about $333 a month. Okay, but in DNP at a 7.6% yield, that's $633 a month. Every month. That's a $300 monthly gap. That's $3,600 a year. Over 10 years, that's $36,000 left on the table. 36 grand. That's not a rounding error. That's a reliable used car. That's a year of groceries for a family. That's a decade of dream vacations you didn't take because you were being safe. And here's the kicker, the part that's hard to wrap your head around. DNP hasn't cut its dividend once in 39 years. Think about what's happened in the last 39 years. The dot-com crash, the 2008 financial meltdown, Black Monday, the COVID pandemic, wars, recessions, market panics. Through it all, that monthly check has been unchanged. That's not luck. That's by design. That's structure. Now, I know exactly what you're thinking. The alarm bells are going off. 8% yield? That's a red flag. I've seen this movie before. It's a yield trap. And you know what? You're right to be skeptical. You should be. The investment world is littered with shiny objects designed to separate you from your money. Most high-yield funds are absolute traps. They lure you in with a big, juicy number, 12, 15, even 20%. You get excited, you buy in, and 6 months later, poof, they slash the payout. The fund's value tanks, and you're left holding a bag, earning half the income you were promised. But here's the problem with that healthy skepticism. The fear it creates pushes you right back into the arms of those safe options that guarantee a slow loss. It's a vicious cycle. Fear of risk pushes you into guaranteed to lose to inflation savings accounts. Wall Street loves this. They profit from your fear. But DNP is different, and the reason is frankly boring. First, it's not an ETF. It's a closed-end fund, or CEF. That just means it has a fixed number of shares, which can lead to some interesting features we'll get to in a minute. Second, look at what it owns. It invests over 65% of its assets in the most boring, bulletproof industries on the planet, public utilities. We're talking electric companies, natural gas pipelines, essential infrastructure, the companies that send you a bill every single month no matter what the stock market is doing, the companies that keep the lights on and the water running. These businesses are built on stable, predictable cash flow, and that cash flow is what fuels DNP's consistent dividend. Now, for the part that feels like a cheat code. This is the feature that almost nobody talks about, and frankly, a lot of big brokerages aren't even set up to handle it properly unless you ask. DNP offers something called a DRIP discount. DRIP stands for Dividend Reinvestment Plan. Here's how it works. Most of the time, because of its reputation, DNP trades at a premium. The market price for a share is a little higher than its actual underlying value, its net asset value, or NAV. When this happens, if you're enrolled in the DRIP, you can reinvest your monthly dividends into new shares at a 5% discount to the market price. Let me say that again. Every single month, you automatically buy more shares of the fund for less money than anyone else is paying on the open market. It's like getting a secret 5% coupon every 30 days to buy more of the asset that's already paying you nearly 8%. Over a decade, that 5% discount compounds on top of the already high yield. The effect is staggering. Most funds don't offer this. Most investors don't even know this kind of thing exists. But the difference this one feature makes over 10 or 20 years, that's another vacation, that's another car, that's another year of groceries, and all you had to do was check a box and maybe make one phone call to your brokerage to make sure they enrolled you in the company's sponsored plan, not their own watered-down version. Now, this brings us to the biggest mental trap that money investors fall into, yield chasing. It's so tempting. You see a fund advertising a 12% yield, then another at 14, maybe even 18%. Your brain short-circuits. It goes, why on earth would I settle for 8% when I can get 18%? But you have to ask, where is that yield coming from? Most of those monster yields are manufactured. They're an illusion. They're often just returning your own capital back to you, which is like taking money from your right pocket and putting it in your left and calling it income. Or they're taking on an insane amount of risk, using leverage on speculative assets, praying for a home run. One bad quarter, one market downturn, and those distributions are not just cut, they're vaporized. The boring investment usually wins. Not because it grows the fastest, it doesn't, but because it is still standing, still paying, when all the exciting high-flying funds have cratered into dust. Think about it. If you invest in a 14% fund and it slashes its distribution by 60% after 2 years, you didn't earn 14%. After the capital loss, you probably earned closer to 9%, but with way more stress, more risk, and a whole lot more regret. Meanwhile, the DNP investors just got their monthly deposit, again, for the 468th time in a row. So, let's talk about the real cost of doing nothing, the price of that comfortable, safe inertia. If you were sitting on $50,000 in cash right now, earning 4% in a savings account, you are leaving money on the table. If you move that capital to a fund earning a 7.6% distribution, that's an extra $1,800 in income you are not capturing. That's in year 1. It's another $1,800 in year 2, and another every single year after that. After 10 years, that's $18,000 in pure passive income that you chose not to receive. Not because you took some crazy risk on a meme stock, not because you tried to time the market, simply because you understood your options and made a better, more informed choice about where to park your capital. And here's the uncomfortable truth that the financial industry doesn't want you to think about. Playing it safe is not a neutral act. It has a price, and that price is paid in lost opportunities, lost compounding, and ultimately, lost freedom. So, here is your 24-hour challenge. Sometime today, I want you to pull up your brokerage account or your banking app. Look at where your cash is sitting. I mean, really look at it. Calculate what that money is currently earning you per month. Write that number down. Then open a new tab. Look up the ticker DNP. Find its current monthly distribution and its price. Calculate what a position of the same size would generate you each month. You don't have to buy anything today. You don't have to sell anything. Just run the numbers. Put them side by side. and let that math be uncomfortable for a minute. Let the reality of the numbers sink in. Then you can decide, because you have a choice. You can keep playing defense, hoping inflation doesn't eat your lunch, or you can start playing to win. The smartest money isn't loud. It doesn't brag on social media. It's just quietly, consistently compounding in the background, while everyone else is still scrolling, still waiting for permission to act. And that's the real secret, isn't it? The boring, consistent, quietly compounding investment almost always wins in the long run. Not because it's exciting, but because it is still standing when everything else is dust. Subscribe to Money Machine. Next week, we're breaking down the 3 other funds that quietly outperform the market while everyone else is chasing the next big thing. See you there.